This is Quent Bilo with an introductory discussion for managerial accounting. We'll discuss managerial accounting basics in contrast to financial accounting. Their focus is different. We'll identify the broad functions of management and how managerial accounting assists these functions. We'll define 3 production stages with corresponding inventory accounts and 3 classes or elements of manufacturing costs, and contrast product costs from period costs. We'll concentrate on the topics indicated and save the rest for an additional discussion. To date, all our accounting attention has been on the subject of financial accounting. Managerial accounting is a fairly dramatic shift in emphasis. Whereas financial accounting looks to providing general purpose information to outside parties on a regular basis, managerial accounting looks inward to management, providing them with whatever information they may need to run the business. For example, there's a need for accurate information about the cost of each product to determine profitability. Also need to adjust quantities of production and its impact on production costs and profitability. These are all covered in subsequent chapters that are related. We'll also look at the need for managers to consider alternative courses of action in a later chapter, 26, the preparation of budgets in order to plan for the future, comparing budgeted numbers with actual results to evaluate performance, and the need to make substantial investment decisions such as the building of a new plant or the purchase of new equipment. Again, all these topics build on managerial accounting. Let's compare managerial accounting with financial accounting in detail. 5 different areas here: the primary users of reports, the types and frequency, the purpose of reports, their content, and any verification process. First, in financial accounting, our focus was external users, stockholders and creditors, compared to managerial accounting, where our focus is internal users, managers and other employees of the company. The type of reports, financial accounting is regular reports, quarterly or annually. For managerial accounting, they are internal reports as frequently as needed. Type of reports, financial accounting is general purpose. Managerial accounting, specific purpose for specific management decisions. The content of the reports, financial accounting pertains to the business as a whole, highly condensed reports. Managerial accounting pertains to various divisions of the business. They can be very detailed, and these reports extend beyond double entry accounting. Financial accounting, the results are generally audited by a CPA for publicly held firms. Managerial accounting, GAAP standards do not apply. There are no independent audits to managerial accounting. Review question. Managerial accounting is best described by it places emphasis on special purpose information. It helps managers make decisions, not providing information to parties outside the organization. Let's look at the general functions of management: planning, directing, controlling, common to all organizations. Planning includes maximizing short-term profit and market share, ensuring the environment is protected, doing activities that add value in general to the business. Directing, coordinating many activities within the company to produce a smooth running operation. Controlling, keeping track of activities and deciding when changes are needed to get back on track. Business ethics have been highlighted in the last decade due to some very flagrant violations by senior management of various companies. The Sarbanes-Oxley Act of 2002 was meant to increase penalties for misconduct, and it requires that there be certifications from the chief financial officer and the chief executive officer that internal controls exist to ensure that financial reports have integrity. Question. The management of an organization performs several broad functions. They are D. Planning, directing, and controlling. Here's a brief exercise. These are true or false questions. Managerial accountants have a single role with an organization, collecting and reporting costs to management. True or false? False. They can provide many different reports, both of financial character and non-financial character. 2, financial accounting reports are general purpose and intended for external users. True. They look outward. Managerial reports are special purpose and issued as frequently as needed. True. Managers' activities and responsibilities can be classified into 3 broad functions: cost accounting, budgeting, and internal control. That'd be false. We're talking about planning, directing, and controlling activities, general management activities. As a result of the Sarbanes-Oxley Act, managerial accounting reports must now comply with Generally Accepted Accounting Principles, or GAAP. False. Managerial accounting is not constrained by GAAP standards. Top managers must certify that a company maintains an adequate system of internal controls. That would be true. That's what the Sarbanes-Oxley Act brought into play. What kind of questions should managers ask to ensure a smooth-running firm? Such as, what kind of costs are involved in making a product or performing a service? If they change production volume, what will the effect on costs? In other words, how will costs behave? What impact will automation have on total costs? How can we best control costs? To answer these questions, managers need reliable and relevant cost information. There'll be several what I'll call triple plays in this chapter and the next. We are dealing with in the context of a manufacturing plant. We'll discuss 3 stages of production, 3 inventory accounts for a manufacturing company that parallels the production stages, and 3 cost elements or classifications in the plant. Stages of production, 3 of them. Prepare, do it, and store it. What are we talking about? Getting ready to make something, purchasing raw materials. Secondly, make it. Convert the raw materials into goods, manufacturing phase, the heavy action stage. And lastly, store what's made. What's that? The finished product, ready for sale. Let's look at the 3 inventory accounts that parallel these production stages. So for the purchase of raw materials, what inventory account are we looking at? Raw material inventory. Converting the materials, here we're actually working to produce something. We'll have a work in process inventory account. And the last stage, storing finished product, we'll have a finished product inventory account. The cost categories in the manufacturing plant: direct material. These are raw materials that are directly traceable to the finished product. Direct labor. This is labor directly involved in the assembly of the product. And all else indirect cost that we call manufacturing overhead. I want you to see the contrast between direct costs and indirect costs. This is an important one. We'll come back to this time and again in this chapter and the next. Let's look at the 3 manufacturing cost elements. Manufacturing consists of activities and processes that convert raw materials into finished goods. The costs are classified as either direct materials, direct labor, or everything else called manufacturing overhead. Again, note that manufacturing overhead costs are the remainder of all product costs that are not direct materials or direct labor. By definition, they are all called indirect manufacturing costs. Cannot be directly traced to the product. Let's first discuss direct materials. They are raw materials that are used in the manufacturing process. Specifically, they are materials that can be physically and directly associated with the finished product during the manufacturing process. Indirect materials are also raw materials that are used in the manufacturing process. However, indirect materials are not physically part of the finished product, or they are an insignificant part of the finished product in terms of cost. Indirect materials are considered part of manufacturing overhead. Direct labor, work of factory employees that can be physically and directly associated with converting raw materials into finished goods, such as assembly workers. This contrasts with indirect labor, work of factory employees that has no physical association with directly making the finished product or for which it's impractical to trace costs to the goods produced. Indirect labor is considered part of manufacturing overhead. Manufacturing overhead are all indirectly associated costs of manufacture. This includes manufacturing costs that cannot be classified as either direct materials or direct labor. Manufacturing overhead includes such things as indirect materials, indirect labor, depreciation on factory buildings and machines, insurance, taxes, maintenance on factory facilities, etc. Everything that's not classified as a direct material or direct labor is called manufacturing overhead in the plant. I'll let you read through this discussion. Interesting to note that factory wages are about twice the wages of employees in the service sector of the economy. And also look at the question at the bottom. In what ways does the shift to automated factories change the amount and composition of product costs? Well, direct labor costs would decrease as machines are added automation, and so therefore manufacturing overhead costs would increase because that picks up the machine depreciation and maintenance costs. So there's a shift in the composition of product costs as factories are more and more automated. Review question. Which of the following is not an element of manufacturing overhead? Sales manager salary. Why? Because this is a cost outside the manufacturing plant. This is what we'll call a period costs. Manufacturing costs are product costs incurred in the context of the plant. Period costs are incurred outside the manufacturing plant. Let's look at a closer definition of product costs. First of all, the components, direct materials, direct labor, manufacturing overhead, with the abbreviations indicated on the right. These costs are necessary and an integral part of producing the product, hence they're called product costs. All these costs are recorded in inventory accounts on the balance sheet. They are not expensed until the goods are sold. When they're expensed, we'll see an account called cost of goods sold. Please see the alternative terminology for product costs. They're also called inventoriable costs because they flow through inventory accounts on the balance sheet. Let's contrast this with period costs. They are charged to expense as incurred. They are not inventoriable. They do not flow through an inventory account. They are non-manufacturing costs incurred outside the plant. They include all selling and administrative expenses. For example, sales managers, the CEO of a company, the CFO of a company would all be in the selling and administrative category. Period costs, expensed as incurred. Here's a chart which simply distinguishes product costs on the left, manufacturing costs, with period costs on the right, non-manufacturing costs. Now, the non-manufacturing costs are part of a manufacturing company. They're just costs incurred outside the factory, not involved in the producing of the product. So product costs, direct materials, as we've seen, direct labor, and manufacturing overhead. All other costs in the factory other than DM and DL. Note that manufacturing overhead includes indirect materials and indirect labor and other indirect costs, such as depreciation, plant manager salary, etc. Period costs, selling expenses, and administrative expenses outside the manufacturing plant. Product costs are inventoried. Period costs are expensed as incurred. Let's do an exercise that classifies 9 different costs of a bicycle manufacturer. Costs such as tires, salaries of employees who put the tires on the wheels, factory building depreciation, lubricants, spokes, salary of the factory manager, handlebars, salaries of factory maintenance employees, and other indirect material costs. Let's classify each cost as either a direct material, a direct labor, or a manufacturing overhead component. Tires would be in direct materials. They can be directly associated with the final finished product. Spokes, again, directly traceable to the finished product. Handlebars, again, physically traceable to the finished product. Salaries of employees who put tires on the wheels. Direct labor, this is part of the assembly labor. People responsible for producing the product. Both direct material and direct labor costs can be directly associated to the inventory being manufactured, the inventory product being manufactured. What are overhead costs? Lubricants. They're materials, but they can't be directly associated with the product. You can't look at the bike and say, I see how much lubricants went into that. Factory depreciation. Using up of the useful life of long-lived equipment. Factory manager salary and all indirect labor are overhead costs. Factory maintenance employee salaries are overhead costs. All indirect materials are overhead costs. For instance, you would consider a lubricant to be an indirect material cost. Manufacturing overhead costs are all indirect costs, contrasted with direct materials or direct labor. We'll be returning to a detailed accounting for direct material, direct labor, and manufacturing overhead in the next chapter. Specifically, how these cost elements are first accumulated in three generic accounts: a raw material inventory account, factory labor account, which initially includes both direct and indirect labor, and the manufacturing overhead. And then we'll see how they are assigned or progressed through the work in process inventory account. These are detailed costs of direct material, direct labor, and manufacturing overhead coming in as debits, increases to an asset account. Transferring those costs to a finished goods inventory account when the product is completed. And then finally transferring the debit into a cost of goods sold account. In other words, expensing those costs on the income statement when the inventory is sold, when the finished goods inventory is sold. You should ensure you understand the inventoriable nature of all manufacturing costs. They all stay on the balance sheet as assets until finished goods are sold. Whether it's a raw material inventory account, a work in process inventory account, or finished goods inventory account, these are all current assets. They then become expensed in a cost of goods sold account when the finished good product is sold. This is a chart of the three inventory accounts in manufacturing plant: raw materials inventory, work in process inventory, and finished goods inventory. And I want to highlight the costs that flow into these accounts, what I'll call additions, and costs that flow out of them, subtractions. So assets are increased with debits, so the additions coming into a raw material inventory account, for instance, are purchases of raw material. We debit inventory, credit cash, debit inventory or credit accounts payable, as raw materials are purchased, how they're accumulated. When do costs flow out of or are subtracted from the raw material inventory account? When direct material is used or indirect material is used. We credit raw materials inventory and debit follow-on costs for the usage of direct materials and usage of indirect materials. The work in process inventory account. As work is started on production, all total manufacturing costs, TMC costs, flow through work in process as a debit. We're talking about direct materials directly charged to work in process, direct labor charged to work in process, and manufacturing overhead is applied to the work in process account as a debit to increase work in process. As goods are completed, they are removed from the work in process inventory account with a credit. That credit represents the cost of completed finished goods. The chapter calls these the costs that are removed from work in process are called cost of goods manufactured, abbreviated as COGM. These are costs of, again, of completed finished goods. Those costs are transferred to the finished goods inventory account as a debit. So it comes out of work in process as credit, goes in as a debit to finished goods inventory. And as the finished goods are sold, those costs come out with a credit, cost of goods sold, and are transferred into a separate cost of goods sold account, which is an expense account on the income statement. In a follow-on discussion in this chapter, we'll go into the cost of goods manufactured in more detail, COGM. Again, this represents the cost of completed saleable product that are put into the finished goods inventory account. A calculation of the cost of goods manufactured is key in this chapter. These costs are calculable in an important schedule. The deduct or subtraction from work in process is the total cost of goods manufactured as calculated in the schedule that we'll look at in a subsequent talk. To briefly summarize the costs that flow through the work in process inventory account, you'll have some beginning inventory carried over from the previous month. TMC is the current total manufacturing costs of the present period. COGM costs, as goods are completed, their costs are removed from work in process. The COGM entry is a credit that leaves an ending balance in work in process at the end of the current period. Again, COGM costs are costs assigned to completed goods, cost of goods manufactured. I want to emphasize a generic flow of costs through any inventory account, be it raw material, work in process inventory, or finished goods inventory. Here's characteristics of costs as they flow through an inventory account. It's what I call the base formula. The beginning balance of an inventory account plus any additions during the month equal the total costs available during the period. These total costs then form a pool that either at month end is still there or it's subtracted because it moves on to the next level. So our available dollars are a source of our dollars that are subtracted or ending values. So the available dollars, the B plus A, are the source of the S and E values. Subtracted costs that are moved out of the inventory account and ending balances of the inventory account at the conclusion of an accounting period. So B plus A pool of cost always equals the S plus E pool of cost. This relationship always holds. Again, what I call the base formula. It's irrespective of any inventory account. If you know one pairing, B plus A, you can calculate the other. This will be very helpful in the next chapter.